My question for you is, what do you think is going to happen to the Canadian real estate market? Canadians are growing more and more optimistic about the Canadian real estate market. And this comes as people are feeling more and more safe about their jobs. Signs of a looming recession are fewer and far between. And the Bank of Canada seems to be holding steadfast on their promise to pause interest rate hikes. However, while that optimism seems to be growing, Canadian mortgage insurers are reporting that more and more homes are now underwater, with many of the homes bought in the last 2 years with mortgage insurance now having larger mortgages than what the properties are worth. So on the one hand, it seems like there's more confidence that real estate prices are going to go up, but on the other hand, Canadians are struggling with mortgages that are greater than the value of their properties, while also feeling the pain of rising interest rates. And for those who find themselves in variable rate mortgages with fixed payments, who purchased at the height of the market and had 95% loan to value mortgages, well, they are potentially in for a double whammy. But before I get into all the details, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So do me a favor, hit the subscribe button so more people like you can see this video. It really helps with the YouTube algorithm. Oh, and if you are in the market for a mortgage or your mortgage is coming up for renewal in the next little while, make sure you check out my book, Mortgage Secrets. You can get it for absolutely free at mortgagesecrets.ca. All you have to do is pay the shipping and handling. Okay, so this one's a bit of a doozy because we have competing reports. One that is talking about more and more mortgages being underwater, and another that is talking about the fact that consumer confidence in the Canadian real estate market is growing. And while it appears that people who are looking to enter the market are feeling more confident with interest rates starting to level out, and housing prices obviously doing the same, there's a lot of people in Canada who bought in the last 2 years who are going to feel a substantial amount of pain, both from the perspective of having mortgages that are greater than the amount of what their properties are worth, and also potentially having variable rate mortgages with fixed payments because they chose to get those mortgages at big banks, and as a result have also been negative amortizing. Now the question is, how big is the problem? So I want to jump in and show you the headline here. Mortgage insurers report growing number of homeowners with underwater loans. And the story is pretty simple. Financial disclosures from Canada's 3 major mortgage insurers show that the drop in home prices over the last year has chipped away at the equity in homeowners' properties. A rising number of them now owe more than their homes are worth, which ramps up insurers' risk of payout. So in other words, the potential problem here is if a borrower defaults and the lender and subsequently one of the insurers have to put that mortgage into foreclosure, there is the risk that they won't be able to sell the property for an amount that is greater than what is owing on the mortgage, and subsequently, the insurers are at greater risk of having to pay out the losses to the banks. Now, if you have an insured mortgage in Canada, no matter where you are in Canada, it is a recourse mortgage. So what this means is if you were to default on your mortgage, you would then have to go to the insurer and negotiate in order to make sure that they didn't pursue you for the losses. And of the 3 insurers, Canada Guarantee, Sagan, and CMHC, Canada Guarantee is reporting that mortgages with a loan to value above 100%, so in other words, people who owe more than 100% of their property value, has risen by 6 times to nearly $4 billion worth of exposure in the 4th quarter of last year. Now, that doesn't represent the potential losses. The potential losses are significantly lower than that because the losses are only realized if somebody defaults and then the insurer has to go through the process of selling that home, and those losses would be isolated to the shortfall after all the costs of selling the home. But what's interesting is that represents 5% of its outstanding insured mortgages for individuals according to Canada Guarantee's quarterly portfolio metrics. So if these numbers are consistent for both CMHC and Sagen, then potentially 5% of insured mortgages in Canada could be underwater, which is obviously a major risk to the Canadian housing market. Now, thankfully, housing prices have seemed to have leveled out and consumer confidence is starting to go up, which we'll get to in a second. But while Canada Guarantee is reporting that this number is quite high, CMHC is reporting that 1.2% of mortgages are over 95% loan to value in their portfolio. Now, this could be largely due to the fact that CMHC has a significantly bigger portfolio, or it could have to do with stricter underwriting standards. But according to a CMHC representative, only 0.3% of CMHC's total outstanding portfolio has a loan to value over 100%. So in other words, the numbers being shared by CMHC are drastically different than those being shared by Canada Guarantee. And CMHC's numbers would indicate that the number of people who are actually underwater is pretty insignificant. Now, you might be sitting there thinking that makes no sense whatsoever, and I can understand how you might think that. But if we look at the markets that tend to have insured mortgages, they weren't the markets that had the most irrational exuberance. They aren't the Vancouvers and the Torontos, albeit some of those mortgages were insured, but a lot of the properties bought in those 2 big markets were over $1 million in the last 2 years, which made them ineligible for insurance. Now, perhaps part of the reason why Canada Guarantee has significantly more exposure to underwater mortgages is because they have a greater market share in Toronto and Vancouver than they do in other areas. But for CMHC, which is very much the insurer of choice in Canada, they would have a significant amount of mortgages in places like Alberta and Saskatchewan and Manitoba and other parts of the country that typically have property values under $1 million and therefore are insurable. And keep that in mind when you consider whether this is a massive issue or not, because a lot of the markets in Canada aren't seeing major crashes or corrections. In fact, in places like Calgary and Edmonton and different parts of Saskatchewan and Manitoba, the amount that property values have come down in the last 2 years, even in the face of rising interest rates, is actually fairly insignificant. Now, contrast that with the bigger markets, Toronto, Vancouver, big interest rate increases, big falls in real estate prices, anywhere from 15 to 20%, and you could see why that would be concerning in some of those markets. Now, one thing to note here is that Canada's mortgage insurers are very well capitalized. They can likely withstand any major shocks in the market, at least the types that could reasonably be expected, very well. In fact, they forecast for these sorts of things, they stress test their portfolios, and they are prepared for the absolute worst case scenario. In fact, you may remember the then CEO of CMHC suggesting at the beginning of the pandemic that housing prices could fall by as much as 30%. Obviously, that isn't what happened, but in the event that that happened, they had already stress tested their portfolios for exactly that. Now, on top of all that, the federal government backs mortgage insurers. So for CMHC, it's up to 100%, and for Sagen and Canada Guarantee, it is up to 95%. So even if they weren't well enough capitalized to withstand a major fall in real estate prices and a major default crisis, they do have the full support of the Canadian government. Which, take that for what it's worth. Perhaps you think that's a good thing, perhaps you don't, but they do have that in their back pocket. Now, even with a growing number of mortgages that are underwater, confidence in the Canadian real estate market is continuing to grow. And this is the headline from BNN Bloomberg: housing optimism is back in Canada, boosting consumer confidence. And this comes on the heels of a report from Nanos that suggests that the Bloomberg Nanos Canadian Confidence Index has risen to 50.4. Which basically means that there are as many people thinking that real estate is going to go up in value as think it is going to go down in value, with 50 being a neutral score. Now, back in October, the score was 42, but since the Bank of Canada has committed to pausing interest rates, that sentiment has increased quite substantially. And the Consumer Confidence Index has 3 numbers that I like to look at. First and foremost is the Consumer Confidence Index. Second of all is the respondents that expect housing prices to rise. And third is the respondents that expect housing prices to fall. Now, the charts you're looking at on the screen are the confidence index and the percentage of respondents expecting housing prices to rise. And as you can see, this number has been steadily rising over the last couple of months. And as that number starts to rise, you can expect that consumer confidence is going to create a floor in the Canadian real estate market. So I'm not necessarily going to come out and say that housing prices have found their floor. However, it does appear that seems to be what is happening. The pause in rising interest rates, along with lower fixed rate mortgages, as well as what seems to be some relief from falling housing prices, is having consumers more confident in the fact that they've found the normal levels. And we're seeing this in many markets as the spring market gets a little bit hotter. We're seeing multiple offers in places like Toronto, Vancouver, and here in Calgary. And it just seems in general that people are willing to dip their toes back into the market, especially as from a macroeconomic level, it starts to seem like things are going to be good and we've found that soft landing. Inflation seems to be falling, the job market is steady, wages seem to be rising, albeit not at a scale that is too much. And in general, it just feels like Canadians are becoming a little bit more confident in the economy, which is good for the real estate market and, of course, the economy in general. Now, if jobs remain steady and people are able to continue to make their mortgage payments, whether they are underwater or not, that's a positive sign. And you have to think that most people are going to try to hold on to their properties in order to avoid destroying their credit, even if it means holding onto those underwater properties for 5 to 10 years in order for those property values to come back to where they were when they bought them. And that means that many people may find themselves renting out those properties, which is also a good thing for the rental market because it means potentially more supply as people try to hold on to those properties. So again, obviously conflicting reports here. My question for you is, what do you think is going to happen in the Canadian real estate market? Do you feel better about the Canadian real estate market? And honestly, this might be a really interesting test because this channel has significantly more reach than the 250 people that Nanos calls on a weekly basis. So leave me in the comment section below what you think is going to happen in the real estate market, whether you think it's positive, whether you think it's negative, and whether you buy into the fact that Canadian consumers are feeling more confident about the Canadian real estate market. Oh, and if you want to see the most recent update on the Canadian real estate market, check out this video right here.